Hi, my name is Gautam, and it is a real pleasure to have you as my audience. I recently founded this firm called Prathimius Consulting, which is into financial consulting, financial education, and financial inclusion, and we are based in India. Besides other verticals, we are also into equity research. Over the next few days and weeks, I would be doing such similar videos in order to communicate with you about the crisis that was and the crisis that could come by if adequate and appropriate steps are not taken, and how could one convert this crisis into an opportunity. Before we go any further, let me mention that we strongly believe in the virtues of value investing and strongly believe in principles laid down by the likes of great men like David Dodd, Ben Graham, and Warren Buffett. These are very interesting times that we live in. If you take the right decisions, you could make a lifetime's fortune. A wrong step and you're doomed. This is probably the first time in history, or maybe at least since the time that I was born, that all asset classes have gone up simultaneously. Indian equities have more than doubled since their March 2009 lows. The S&P 500 is touching 1200, and the Dow Jones Industrial Average has crossed 11,000. Gold, which peaked at $1,225 a troy ounce maybe a month or two back, is currently trading around 1150. Commodities once again are bubbling. Oil, which of course substantially below its high of $147.27 a barrel, reached in July of 2008, currently trades around $85 a barrel. Copper is pretty much just about 10% lower than its all-time highs of about $8,900 a ton. Currently trades around 8,000. Real estate is beginning to create speculative excesses in places such as China, and of course art, which never really went down, is doing wonders now at auctions at Christie's and Sotheby's. Having said so, we strongly think that something's got to go down, something's got to break. We are in the camp that the world is soon going to experience a double-dip recession. Agreeably, economic data that has been coming out the last few days has been very encouraging. America, for the first time in the last 3 years, added jobs. Consumption has picked up in America. Having said so, let me also mention that such good economic data has come on the back of government supports in the form of tax credits for first-time house buyers, in the form of cash for clunkers, which of course expired quite some time back. And therefore we believe that once this artificial support is taken off, the economy is going to be just like nine pins, wobbly and shaky, and going to come down in no time. Peter Lynch mentioned that equity analysts would do much better by learning more of philosophy and psychology, and of course doing a lot less of math. With this thought, let me mention that no economy can grow by printing currency. In fact, Jim Rogers mentioned that the rate at which the US Federal Reserve is printing currency, we will soon run out of trees. So we strongly believe that no economic growth can come by printing currencies. The last few years have seen huge economic growth fueled by cheap money. In 1998, when the Asian crisis struck, Asian countries affected by such crisis borrowed and spent their way out of the recession. 10 years later, the crisis in 2008 was solved using similar tools, wherein countries are borrowing a lot of money in order to spend and come out of the recession. Also are printing a lot of currency, which of course is going to have its side effects in the form of much higher debt. So it took 10 years for the next crisis to happen after the Asian debt crisis. And let me tell you that the next crisis, of course, is not going to take that long. It is going to come much sooner than that. And the sad part is that we will be left with no ammunition if and when such crisis strikes. interest rates in the developed world are at near zero levels. Fiscal deficit is running at all-time highs. In fact, the American economy has had a fiscal deficit of about 12 to 13% of GDP last year. The UK economy is also having a fiscal deficit as high. And therefore, if such crisis strikes again, we would be left with no economic tools to overcome such a crisis. Given this, we would strongly recommend that investors stay away from risky instruments such as equity shares. Of course, governments could maybe support this growth for a few more months through artificial supports as I just mentioned, but we don't see this growth lasting for very long because of various factors such as a sovereign debt crisis that may happen, inflation that may come about as a result of the huge amounts of currency that various countries have printed, because of the loose monetary policy that various central banks have been following, and like I just mentioned, that China is soon speculated to have a real estate bubble, and therefore we would strongly recommend that one stays away from risky instruments. And for the very same reasons, it is highly advisable that an investor has at least, say, about 15 to 20% exposure into gold. Thank you. We will continue to do such videos at regular intervals so that we can inform you about things that may come across in the next few days and how one can actually benefit and take advantage of these manipulations that governments across the world have been up to in the last couple of years.